Venture capital is investing in early-stage private businesses. These businesses need capital to grow, and investors are looking to benefit from that. For the investor, the return can be outsized. This naturally comes with risk, things like management execution, technology, and market acceptance. But for prudent investors that can construct a diversified basket of VC investments, this is an asset class that can be accretive to portfolio returns. Growth is a key characteristic, typically driven by innovation, companies creating new product or service that's better than what's been offered before. Think about Uber and the taxi industry, how a mobile phone with GPS and a good screen, combined with an internet connection, completely disrupted an industry and led Uber to grow revenues by 15 times over 7 years. There are some similarities with private equity. Both PE and VC are investments in private businesses. There's no stock exchange through which an investor can find and buy stock, which means VC, like PE, is illiquid with long time horizons, typically 5 to 7 years. Also similarly, both require a lot of work to source, identify, and close on attractive opportunities. Fees are higher than in publicly traded equities, similar to PE, but the returns and limited correlation with the broader equity markets can make it well worth it for investors. The key difference, though, is that in VC, these younger businesses have a very high level of growth, but typically are not yet profitable, so they require outside capital. PE investing involves more mature businesses, so often slower growth, but because they're cash flow positive, they don't need new capital. We're looking to generate attractive returns for our clients through a diversified pool of VC investments, a basket of high-quality opportunities sourced through the best partners we can find. Selecting the right partners is critical. We look for groups with extensive track records, differentiated deal flow, and evidence of great investment acumen. Often, they're the experts and thought leaders in their industry, which keeps us close to the trends, which in turn helps us better underwrite the next investment. For example, one of our US partners has been investing in VC for several decades with a top quartile track record. We are opportunistic when it comes to vehicle, which means we invest in funds, direct co-investments, as well as secondaries. I think we're different in a number of ways. In terms of structure, our VC fund is an evergreen fund, which allows our clients to get immediate exposure and diversification without having to commit anything further than their initial investment. We're flexible. We don't only invest in other funds, but we also invest directly in businesses when they're backed by one of our partners. We also invest in secondary opportunities, typically where a seller is seeking liquidity where we can buy positions in high-quality VC funds at very attractive prices. We're independent, which gives us the ability to seek the highest quality partners we can find, which means we're constantly improving our roster of partners. We're integrated, we're part of the Nicola platform, we're in constant dialogue with our advisors and other portfolio management teams, which allows us to offer a differentiated portfolio that's most suitable for our clients. VC is an attractive asset class that we expect over the long run to generate strong returns and be a complementary part of a well-diversified portfolio.